Hi, my name is Drew Halfmann from the Sociology Department at UC Davis. Today I want to talk about the question, what is the hidden welfare state? So, three definitions. First, taxation. Taxation is when the government collects money from the taxpayers. Second definition, tax expenditure. You can also think of it as tax spending, which is kind of a weird concept. In a tax expenditure, the government gives a tax break to a taxpayer if that taxpayer performs a certain activity. In other words, the government does not collect money that it could have collected because that person did a certain thing, like bought a house, for example. Now, the hidden welfare state is a particular form of tax expenditure. It's a tax expenditure that tries to achieve social welfare aims of some sort. The four big parts of the hidden welfare state are as follows, and this is in billions from 2011. So the big tax expenditures. First is the exclusion for employer-provided medical insurance. If your employer gives you health insurance, that's not considered part of your wages. It's not taxed. The government could tax that, but they've chosen not to because they want to provide an incentive for employers to provide health insurance. That subsidy for employer-provided health insurance is $177 billion per year. The next biggest is the home mortgage interest deduction. If you buy a home and pay interest on a mortgage, you can deduct that interest from your income. So every year the government spends, through the tax system, $104 billion on that program. Another is when you make contributions to a retirement plan. Those contributions are not taxed. They're not part of your taxes that year. They're excluded from taxation. That's a $67 billion program. And lastly, when you make contributions to charities such as Goodwill or Red Cross, those deductions are tax deductible. The amount that you contributed comes off of your income when you calculate your taxes. So those are the four big dimensions of the hidden welfare state. Let me give an example. Health insurance. So let's say that your employer determines that you are worth $100,000. Okay? And let's also imagine that your income tax rate is about 30%, which is actually a little bit high. Maybe I should lower that for future slides. So there's two options here. So one is that the employer could give you $100,000 in wages and no health insurance. Okay? If that were the case, you would lose $30,000 in taxes that year if you have an income tax rate of 30%. Okay? Another option, though, would be for the employer to give you $90,000 in wages and $10,000 in an insurance policy. You're still receiving $100,000 in compensation. You're receiving the same amount of compensation, but your tax hit is lower because that $10,000 that paid for your insurance policy is not taxed as part of your wages. So you end up paying $27,000 in taxes rather than $30,000 in taxes. So this is a way for the employer to provide you with additional compensation over and above the $100,000. There are other reasons the employers do this as well. They can deduct the cost of providing insurance to you as a business expense, thus reducing their taxable income. In addition, employers can typically buy insurance more cheaply than individuals can, and so this allows them to provide additional benefits for their employees. So that's the hidden welfare state. That's tax expenditures. The hidden welfare state is unequal for a variety of reasons. So the first reason is that it's really only the good jobs that have these types of benefits attached to them. So, the good jobs have health insurance. The good jobs have some sort of pension contribution from the employee. And so not everyone receives these subsidies from the government. Only people who are getting these benefits from their employees. Those benefits are more available in larger companies, in unionized industries, and in better paying occupations. In fact, some employers will even provide health insurance for their high paid employees and not for their lower paid employees. So you'll even find inequality within a firm. In addition, there are some benefits being provided through tax expenditures that reward activities that the poor cannot afford. Home buying is a good example. So billions of dollars are spent each year to subsidize home buying, but the poor who do not buy homes do not see any of that money. In addition, the tax relief that's provided by these tax expenditures is most valuable to people who have high tax rates, people in the higher incomes. So that's another reason why this is especially beneficial to the wealthy. And then lastly, if your income is low enough that you do not itemize your deductions, or if you don't own a home. Many people who don't own a home don't itemize their deductions at tax time. They take the standard deduction, and thus they don't benefit from any of these special tax expenditures. Now, tax expenditures have an interesting kind of politics because both liberals and conservatives like tax expenditures, and this creates some political opportunities. First of all, conservatives like tax expenditures because they believe that they're less intrusive and less bureaucratic. They provide incentives rather than commands. So a good example of this is instead of the government creating a child care program for the nation's children, instead, what conservatives would prefer would be to provide a tax subsidy to help people buy private insurance. Okay? They argue that this promotes individual choice, it promotes consumer sovereignty. It's also compatible with classical liberal values, values of limited government and individual liberty, keeping government small, letting people make their own choices, but providing some assistance to help them make those choices. These programs are also popular with the left because they are providing aid to some needy category of citizens. They're popular with moderate Democrats because they appeal to the middle class. The right also sees them not only as an alternative to government programs, but they can see them as a tax cut, as a tax reduction. You're not paying as much in taxes because of this program. And then lastly, there's quite a bit of support from various provider interest groups. For example, the health insurance industry. The government is helping firms to buy insurance for their employees. That aids the health insurance industry, and so they end up lobbying for these types of tax expenditures. So, in sum, tax expenditure politics are sort of unique. Tax expenditures are enacted relatively easily, and this suggests that there are possibilities for expanding social policy beyond the big boom of the New Deal or of the Great Society. They have support from both moderates and conservatives and from the left. They're often pushed by providers rather than beneficiaries, such as employers, insurers, the healthcare industry. They often grow even during times of deficit and during times when the welfare state is under attack. And lastly, they're very hard for policymakers to control because they're very popular. You know, the home mortgage interest deduction, for example, most of the research has shown that all that it doesn't really help people to buy houses. What it actually allows people to do is buy bigger houses than they would have otherwise done. That's not particularly good for the environment. It's not a particularly desirable policy goal. But, you know, nobody wants to give up their home mortgage deduction. I just bought a house and I don't want to give up mine either. So these programs are hard to get rid of, and they tend to grow. Thanks very much.